Yes. So we would come to the grand finale of this chapter. Now, the whole intention of bringing in this chapter 2.4 is only to kind of, to connect all the strings because we know that, we know about all the charging mechanisms now. We know about QDMTT, we know about IIR, we know about UTPR, we know how it is calculated also. But how can you see everything all together? See, what are the streams involved? So this chapter would give you a definite concrete clarity as to how to apply all of them together. Because all this while we were talking about all these in silence. Okay, so after learning, you will be able to calculate the complete top-up tax allocation from jurisdictional totals to individual parent entity liability, handling minority interest and post. So we will do a whole combined. So this would clear all your doubts. Okay, so yeah, so basically, the hierarchy. First, it is QDMTT, then it is IIR, and then it is UTPR. So, if we see the hierarchy, the taxes would be calculated first. There would be juridical calculations, and then there is entity allocation, and then there is parent allocation. Correct. So, this is the hierarchy in which it goes. So let's understand these multi-stage process in a little bit more detail with examples so that we check all the boxes when it comes to understanding. Now, yeah, the complete allocation process. Now, before we move ahead, I have been telling you that first level is QDMTT, but before that, in the earlier chapters, like constituent entity, and once we are starting, I told you that everybody has to pay 15% taxes in minimum, right? Now, is it calculate? How is it calculated? Is it calculated entity wise or is it calculated juridical wise? I mean, jurisdiction wise. How is it calculated? So, I would say that there are let's take an example. Let's take that this is UPE. Okay, this is UPE, and then there is another company, and then there is one more, and then this holds one, and this holds one. Okay, so let's say that this is UPE and it is in one jurisdiction. This is another entity, constituent entity, and in the same jurisdiction as UPE. Okay, this particular guy is in another jurisdiction. This is also a constituent entity which is in another jurisdiction. This also is in, let's say that this is a constituent entity which is, each colors represent different jurisdiction, let's say, and this is in the same jurisdiction. Okay, so let's change this guy. Or let's change this guy. Let's say these two are in the same jurisdiction. Okay, each color represents jurisdiction. Okay, so it is like this. UP holds these two companies, and this company holds this company, and this company holds this. Okay, each color represents different jurisdiction. Now you tell me 15% tax has to be achieved per jurisdiction or per entity. How is should be understood? 15% has to be for each jurisdiction or for each entity. Should these two entities being in the same jurisdiction together pay 15%, or should they pay 15% differently? Separately, should they pay 15%? I'm looking for some answers now. How do we determine top up taxes? So Melvin says it should be per entity. Anybody else with different opinions? So everybody says separately. My dear friends, I would like to kind of change your whole perception. It is 15% in each jurisdiction. Okay, it is not 15% per entity. It is 50. If M&E group has a constituent entities in any jurisdiction, in that jurisdiction you have to pay 15%. So how it would happen is, like, since these two are in the same jurisdiction, they will be calculated together, whether they are paying 15% in that jurisdiction or not. Is that clear? Maybe I would not have stressed about this in my earlier video, so that's why. Is this clear? It is per jurisdiction always, and it is not per entity. Yes or no? Can you give me something in chat to confirm? Okay, so that is one basic understanding. Now, then again, the question just pops up. Okay, if this is together seen as 15%, how do I determine whether this is a low tax one or it's a high tax one? How do I allocate this to two entities, right? Let's say that combined these two are having a top up, having a covered taxes or the ETR of say 12%. There is 3% remaining. How do I allocate this 3% among these two first? Because there is initially it is QDMTT, right? Initially there is a QDMTT. So jurisdictional wise they have to pay. So that is the whole essence that we are talking about. It is always seen as jurisdiction basis, not as an entity basis. We'll see all these allocations now. Okay, so this is the background. So again, first level is always jurisdictional. You have to calculate top-up tax for the jurisdiction. Then you have to go allocate this jurisdictional top-up tax to individual constituent entities, and then it goes to the parent level, and then it goes to the UTPR level of other constituent entities. Okay, this is the hierarchy. Since we didn't stress much on, we didn't have a lesson on QDMTT yet, this was not very much stressed. But did you understand how it is calculated? It is per jurisdiction. Okay. Uh, so let's understand these three levels, and I'm sure that what happens at the parent entity level we all know. Parent entity and other constituent entity we have done very good examples. But let's understand what happens at the jurisdictional level, and we'll go to the parent entity level also just to refresh our understanding. So first thing that you have to do is you have to calculate the jurisdictional top. Now, what is jurisdictional top-up tax? What is the top-up tax payable by that jurisdiction? So, in our earlier example, if 12% was the ETR, 3% is the jurisdictional top-up. Okay, this is what we are calculating. Now, what is the formula? It is top-up tax percentage, okay, into excess profit plus additional current top-up tax minus QDMTT. It may look a little bit colorful, but let's break it down. So what is top-up tax percentage? Top-up tax percentage is nothing but minimum rate 15% minus jurisdictional ETR. Okay, this is 3%, correct? This is the top-up tax amount and this is the percentage. So first we'll calculate top-up tax percentage into excess profit. Now what is this excess profit? Excess profit is nothing but net globe income. What is their globe profit minus substance based income exclusion? So there are something called substance based income exclusion which will come. So top of tax percentage into net global income minus substance based income exclusion is what is excess profit. So we are calculating the top up percentage on this excess profit, and we are adding additional current top up tax. So what is this additional current top up tax? Recaptured amounts from previous year. So let's say that last year we did one calculation, we filed one return, and then let's say there was back and forth from the tax authority, and they say that no, this is not your profit, this is your taxable profit. So there would be changes, right? So if there are any changes in the tax filings which we did last year, we have to bring in what changes is there in respect of this year. So that is the additional current top-up tax, which is nothing but recaptured amounts from previous years and minus QDMTT. So this is going to be the jurisdictional top-up tax formula. Okay. So this is the top-up tax that is available for IAR and UTPR and other calculations. Again, what is the top-up tax percentage? How do you get that? Minimum rate minus jurisdictional ATR into excess profits. So what is my net global income minus my substance-based income exclusions plus any recaptured amounts from previous years. If there is any difference between the profit I filed last year and what is the assessed profit by the tax authority, that would be recaptured in the current year. If there is a difference, then that tax for that has to be paid current year minus QDMTT, since we are giving out QDMTT also, the remaining is what is left for applying IAR and for applying IAR. What is remaining after IAR is UTP. It may look a little complex, but trust me, this is very simple. We will do a example for you to understand. So as per ordering rules, QDMTT is subtracted before any amount flows to IAR or UTPR. If QDMTT equals or exceeds the jurisdictional top-up tax, no amount flows to higher level. We know that. We know that, right? I mean, QDMTT is taking care of all this, then there is no amount which would flow to IAR. Okay, so let's understand this. This is the jurisdictional top-up. Okay, let's do a question. So let's say that AR has operations in Singapore. Okay, and in Singapore, they have given the globe income. Now, how to calculate this? This is all chapter 3. They have given the globe income. This is the starting point. And they have given adjusted cover taxes also, payroll cost and tangible assets, and SBIE rate. So let's do this question together so that you will understand how top-up tax is calculated on the jurisdiction. So again, a little refresh. First thing is we are doing the jurisdictional top-up tax calculation. Okay. So let me take an Excel. Oh, 1 second. Yep. Yeah. Let's do this question. For ease of simplicity, I have added the formula also here, so you know which is picked and used. Okay. So let's do. We have to find the jurisdictional top-up tax calculation. So what is step one? We have to find the top-up tax percentage, right? Step one is top-up tax percentage. Now, how do you calculate top-up tax percentage? You have to take what is your globe income. This is nothing but your net profit equivalent in corporate tax. So globe income is what? 15 million. Okay. And what is your adjusted cover taxes? Now, cover taxes means the tax actually paid in that jurisdiction, say corporate tax or any other tax, say capital gains tax, wealth tax. There are a lot of direct taxes, right? What is paid in that jurisdiction? What taxes are covered would be given out by each jurisdiction, and you have to take what is the total tax. So, what is the covered taxes? So these are the corporate taxes and wealth tax and all the other split, which is 1.875 million, 1,875,000, right? So in such a scenario, what is my effective tax rate? Effective tax rate is, this is the amount of tax, this is the amount of globe income that I have. So effective tax rate is, I'll take it in percentages, zeros also. So it is 12.5%. 12.5% is my, yeah. So what would be my jurisdictional top-up tax? Hmm? What is my jurisdictional top-up tax? Can you give me, few instances in chat? What is going to be my jurisdictional top-up tax? Absolutely. So it is going to be nothing but 15% minus what is my effective tax rate, and that is 2.5%. 5%. Okay, this is going to be my jurisdictional top tax. I am going to double underline that. Clear? Step one. What is this? This is nothing but this top up tax percentage, right? This is the yellow, my friends. This I will also mark in the same color so that we are on the same page. Yes. So this is my top up tax percentage. Now, how do I calculate the excess profit? Okay. So excess profit is nothing but my globe income minus. So I'll just take the formula from here. What is excess taxes? Excess profit is net globe income minus substance based income exclusion. So let's see how we can do that. Step 2 is excess. Now we are doing this for the jurisdiction. Huh? So this 15 million is the total of globe income of all the entities in that jurisdiction. Okay. So I'll write total of globe income in all jurisdiction, all entities of the MME group in that particular jurisdiction. Okay, that is how you have to calculate. First, it is all about jurisdiction. So we calculate jurisdictional one, and there is a top-up tax remaining. So we have to find the excess profit. Now, what is the formula for excess profit? Green, net globe income minus substance-based income exclusion. So what is my net globe income? What is my net globe income from the question? It is 15 million, right? I'll just kind of like, take. And then there is substance based income exclusion. Substance based income exclusion. Now, what they are saying is, even though this is the globe income, we will only be taxing excess profit. Okay, excess means if you are in a business which would require, people and assets would be required for business in different levels, right? If you're a capital intensive business, you would need more tangible assets and you would need more manpower to do that, or if you're in manufacturing and all. But if you're a service industry, yes, you need more manpower, but you won't need much tangible assets. If you're a capital intensive, you need more tangible assets and less manpower. So that's how things are. And of course, in terms of business, there should be some investment, and so we will only be tax you on excess of what is allocated for substance requirements, which is manpower and machinery. Okay, so that's the whole idea of providing a substance based income exclusion. And substance based income exclusion is kind of there is a rate which is given for each year. We'll look at that. So they say that whatever is your payroll cost, you get a 9.4% deduction, and whatever is your tangible assets will give you a 7.4% deduction. On top of that is only what we would be taxing. So this is a standard fixed rate, which changes every year. Okay. So let's calculate the substance based income exclusion. So what is the payroll cost? Payroll cost is 4.5 million. Cost is 4.5 million. Okay, this I will push it here for the time being. Okay, payroll cost is 4.5 million. And what is the SBIE rate for payroll? SBIE rate for payroll is given as 9.4%. 9.4%. So what is my payroll exclusion? It is going to be nothing but this into this. Okay, 423 is what is going to be excluded on respect of payroll. Now let's calculate what is my tangible asset one. I have a tangible asset net book value of 8 million. So tangible asset value of 8 million. Okay. And what is my SBIE rate for tangible assets, net tangible assets? It is 7.4 percentage. So I will calculate tangible exclusion. So that is going to be, so 592. So what is my total SBIE? What is my total SBIE? Which is going to be the total of this plus, okay, I'll get an exclusion from my net global income, and the remaining is what is excess. Okay. So excess profit is going to be what is my net global income minus substance-based income exclusion. This is nothing but what is my payroll cost for eligible employees minus and tangible asset. I'll just kind of reduce that. So what I find is excess profit. Is that clear? How to calculate? We'll go to SBI and all. Don't worry. So this is green. Okay, in the formula, this is green. Now we have to see if there is any additional current top up tax. Additional current top up tax, I told you, is nothing but additional current top up tax is nothing but what, let's say that last year's was different and now we are adding what is the income element into this. Now this concept is there in corporate tax also. Let's say that there is a mistake which is costing which you have to pay or receive up to 10,000. You can make a adjustment in 2025 return, correct? In 2024, if you did something which is less than 10,000, say payable or refundable, if there is a mistake, you can adjust it in 2025 return. You remember that adjustment which is coming in 2025 returns? Same cost. If there is any difference in last year, then you have to plus or minus that additional current top of tax. Okay, this is respect of tax which was not paid in respect of the income in the last year. So right now in this question there is nothing. Okay, so that I will kind of say zero, right? So this is blue, and step 4 is QDMTT. What is the QDMTT calculated? QDMTT also we understand from the question that SG has no QDMT. Okay, so there is no QDMTT. So again, this is also zero. Okay. Now you tell me what is the jurisdictional top up. So how much of top up tax do I have to pay from the jurisdiction? So jurisdictional top up tax equal to what? Jurisdictional top up tax percentage, right? Into what is the excess profit plus what is additional current top up tax? We know it is zero. And what is the, and minus plus zero minus what is the QDMTT actually paid. The jurisdictional top up tax is 349,625. This is the top up tax that has to be paid by the jurisdiction. This will now, since it is after QDMTT, now this will go into IAR. This is what the parent entities now have to honor. Are you getting it? The total jurisdictional, how it is calculated on a line level. This is the calculation. Yes or no? It just needs a little understanding and a little practice, but the calculations are all pretty simple. Okay, so 349,625 is what is the jurisdictional top up. Now we only calculated jurisdictional top ups. Now let's go. So again, substance based rates is like, it's a fixed rate that is given by it's there in the law itself. So basically, like, in 24, it's given 9.8 and 7.8. Okay, in 25, 9.6. Since we are doing it in 26, the previous question, we have taken the 26 transitional year payroll and asset cost. So while taking the substance based income exclusion, you have to take what is the rate from this table. Now it is only given till 2033, and after that it will go. And if you see, it is coming down. It is coming down, and in the end, it is going to be 5% for payroll and 5% for tangible asset. This is the only exclusion that they will give you from net global. So this amount, yes, this amount, the jurisdictional top-up tax amount that we calculated would be used for IAR, because we are minus QDMTT is also something that we are doing. So what is remaining would be taken. Now, one question that a lot of people have after seeing this table that is mentioned is that, what if my fiscal year is not calendar year, but let's say that it's April to March or July to June, etc. Now there is a clarification. These rates are based on the calendar year in which the fiscal year begins. So even if you are having April to March, you have to take this for April 2025. Okay, April 25 to March 26, you can use this rate. April 26 to March 27, you can use this rate. Okay, and this clarification has been given by HMRC. So, it's only for UK, but yeah, that is the kind of, notion they have. So, why there is an SBI, I told you, it reflects the political compromise needed to secure agreement with jurisdictions with different economic characteristics. Countries with substantial manufacturing or employee incentive service operations benefit from higher carve-out rates. This is called substance-based carve-outs, as these reduce the excess profit base subject to law. Starting at 10 or 8%, yeah, 9.8 to 7.8, and declining to 5%, 5% over a decade, gives the jurisdictions time to adjust, while declining trajectory ensures carve-out does not permanently shield income from income tax. So again, like, if people are using this as a shield, then to avoid that, they have told that it is only temporary, it's for only a decade, and after which this would be removed. Are you understanding substance-based income exclusion and the rationale while it is given? If that is given, let's go to the next one. The next level is, first we are calculating what is a top-up tax for a jurisdiction, and then we have to allocate within the entities, right? Once the top-up tax, it must be allocated to individual constituent entities. So there are, like, in this example that we have, this is jurisdictional top-up tax that we calculated. Now, how do I distribute it to the other two? So there is an entity allocation rule. It's nothing but, what is the top-up tax? Entities top-up tax is jurisdictional top-up tax into entities globe income divided by total positive globe income and jurisdiction. So you are dividing this jurisdictional top-up tax calculated on the basis of entities globe income. Okay, on the proportion of entities globe income. But in this scenario, while distributing, what they are telling us is, only take total positive globe income in jurisdiction. Don't take, if there somebody is having a loss, then you should not take it. We will do an example, don't worry. So yeah, only CEs with positive globe income receive an allocation. It won't be given to a negative globe thing. I think we already saw this in another concept before while doing UTPR, right? There is something called a UTPR carve out, where somebody who has a loss, either they will be removed from the pool or they would only have 0% allocation. Same concept. Same concept for the jurisdictional constituent entities also. Cs with globe losses receive no allocation, and allocations are proportional to each C's share of positive income only. Let's understand how it is done. So let's say that we calculated the jurisdictional top up taxes, right? So how would I distribute it to? I told you it is on the basis of the globe income, the allocation of globe income. So AR has three entities in Singapore with the following globe income. We calculated the top up tax for Singapore, right? We told you that globe income is 15 million. How did I get total globe income as 15 million? 10 plus 6 minus 1. right? Now I will distribute this 15, this top up taxes, which is 349, into how many entities? Two or three? How many entities? Yep, it is only going to be AQ and JJ. SA will not get because it is in a loss. So there won't be any allocation which is provided to a loss making. Yeah, Sari says true. Absolutely. Now, how do I do that? Let's continue the same example. So we calculated the jurisdictional top up tax. How much did we calculate jurisdictional top up tax? It is 349,625. Correct. Now we will have to divide it on the basis of positive globe income. So let's say what is this entity's globe income? AQ globe income is 10 million. So AQ is 10 and who's the other one? JJ Singapore Tech has 6 million. So JJ has 6 million. Would we take SA also? No, we will not take. We will do it for calculating jurisdictional top up tax. I'll take a total of everybody. But here, I will not take it for entity level distribution. I will not take JJ. So the total tax is how much? Is 16 million. On the basis of that, I would divide. On the basis of that, I would divide the. So for AJ, how much, AQ, how much we'll get? So it's going to be 349 into 1 second. This is not 600,000. This is 6 million. Yeah. Is it 6? 6 million. So based on this, we will divide out of 347. How much is the top up taxes attributing to AQ, which is in the same jurisdiction? It is 10 million divided by. Okay. So is this jurisdictional top up taxes into what is their globe income divided by what is the total globe income for this positive net positive constituent entities. And for JJ, it is going to be this into 6 million divided by 60 million. So that is how you would be distributing the globe income to constituent entities. Is it clear how the jurisdictional top-up tax is distributed? First, how jurisdictional top-up tax is calculated, and then how it is distributed. Is it clear? So we'll just revisit, like, since you just have to find what is the top-up tax rate by taking a total of all entities. Now, while taking this total, you will include what loss-making entities also. Okay, and then you will find out how much is the top-up tax that you are, calculating. Then you calculate excess profit, nothing but net globe income minus certain exclusions that is given under pillar 2. For I'll come to the question once again. Then there is some exclusions which is given under question 2, which is substance based income exclusions. Nothing but your payroll and your tangible asset factor will be taken into consideration, and plus any carry forwards from last year, and if there is any QDMT. So total 349 is the tax that now parent, now it will go to IIR. And with respect to this, how much is the jurisdictional top up per entity? It is going to be on the proportion of the positive global. Okay. Is this clear? On a peripheral basis. Of course, we'll do questions, but let me see the question. For jurisdictional top up tax, will we take negative income? Yes. Jurisdictional top up tax. This is from the same question, right? So you see, what we take for globe income, net globe income is 15 million. For net globe income, we use 15 million. Okay, it's a total for every. Right? Okay. So let's proceed. Yeah, I mean, this was the formula which we use. So first is jurisdictional level, then there is entity level. Why we are doing a jurisdictional level is because 15% has to pay per jurisdiction. That's one. Okay, so then we will calculate what this this 349 will just go to the parent entity. Parent may be IPE or UPE or POPE based on the circumstances. You know what circumstances each will apply. So I'm not going there. But like after entity allocation, the top up tax is charged to parent entities. Now, then you can ask me like, in this scenario, why did you do a entity allocation, man? I mean, since both are having the same parent, why are you doing an entity allocation? That is because sometimes what happens is this maybe, let's say that this is not here, but it is in this group. Okay. And let's say this is a pope or this is a pope. Then we have to find, then he will pay, right? So that is why after finding the jurisdictional one, you have to allocate it to entities. Yes or no? You understand the concept why we are doing it? So this is the whole scenario. Okay, then it goes to the parent level. Parent level, we already know how the parents will do it because we have to find what is the allocable share. Allocable share is nothing but what is the top up tax that we calculate like 300,000 into inclusion ratio. How do I find inclusion ratio? You already know, like, globe income minus amount attributable to other owners divided by globe income. Now, again and again, I'm telling you, please don't take the ownership percentages. It depends on how the profit is distributed among the the parent entity and the minority interest shareholders. It is not dependent on like the ownership percentage. Profit sharing might be different. You have to look at the MOA and find out. And of course, if there is a pope, then you have to find pope comes into the picture. Okay. And if whatever is the pope's share, like top up tax paid by pope into UP's inclusion ratio, we will give them an ops. Right. Instead of this, there would be like, it is the same. We will also give a offset of pope's taxes if any of the entity is a pope. Are you understanding the high level, bird's eye view of how things will go? Fantastic. Yeah. Now, this question is for you guys. Now, you tell me in this manner, how would I do the top up tax calculation? I told you there is a hierarchy. First is jurisdictional level, then entity level, then it will go to parent level, right? So you tell me. Let's assume that question does not say about UK or Netherlands. So let's assume these are not, this is the parent entity allocable share and not jurisdictional one. So let's say that this has, after the jurisdictional and entity level calculations, this particular entity has a top up tax of 200,000. Okay. Now you tell me how will it be paid? Which parent will pay that? Which parent will pay that? Which parent will pay? This top up tax calculation is what we saw, 349, and so which parent will pay the 200,000? I want chats. Who's the IPE? Who's the POPE? Who's the UP? Give me who's going to finally pay the taxes? Who's going to pay 200,000? UK, UP, UK or Netherlands? Who's gonna pay? Come on, guys. I don't know why it's taking so much of time. Yes, I am getting the reply. So Ashik says UK, UP, UK, UP, and everybody says it's going to be the UP. Now, why? Why? Because absolutely there is no POPE there. There is no entity in this chain for which 20% is owned by another person. Right? So who will pay? It all goes to the UP. There is no POP in this example. Now, how much will UK pay? You tell me. In this example, how much will UK pay? How would you calculate? You have to calculate something called inclusion ratio into top of tax, right? Now, tell me how much will the UPE pay? Out of the top of tax of 200,000, how much will UPE pay? Yes. Let's see who's the fastest finger first. No, I want the amount. I've already given you the top up taxes. So how much is the amount that the UPE will pay? You told me UP is IAR will be applied at the UP level here because there is no POP. I get that. I confirm you. But you tell me how much is UPE going to pay in UK? Yes, Sahil, Melvin, everybody is right. It's going to be 160,000 because his inclusion ratio is only 18%. How did I get 80%? 100%, 80% into 100% into 100%, right? So my inclusion ratio is 80%, and this guy would pay only 160,000 as IAR. Now, what happens to the remaining 40,000? What happens to the remaining 40,000? Would it be untaxed? What happens to the remaining 40,000? Exactly, just no. It will have a UTPR because since all taxes are not collected up at the parent entity level, then definitely it will go to UTPR. Now, UTPR, we had a whole session yesterday or day before yesterday, how to calculate. You know how to calculate. After you get the first you have to calculate the UTPR percentage. Who will pay UTPR? Other constituent entities, right? These guys. Right. Now, for that, I have to find what is the UTPR percentage of each guy. I have to find the employee factor and tangible asset factor, right? Into 50%. Then UTPR tax is that UTPR percentage into residual top up tax. Now, you tell me in this question, what is the residual top up tax? What is the residual top up tax in this question? Yep, it is 40,000. Will be played on the basis of UTPR percentage of whom? UTPR percentage of these two. Did you understand the bird's eye view of how things will go? How I calculate this was the first part of our discussion. Then this guy will pay 160. These two will share 40%, 40,000 in the ratio of their UTPR percentage. And how would I find that? By using the employee and tangible asset factor. Is it clear? Yes? Fantastic. So let's understand, like, so the complete allocation workbook is, first one is you have to find jurisdictional top-up tax. Then you have to allocate it with an entity. Then there is parent allocable share. And then there is allocation of UTPR. This is how the charging mechanisms would apply. My guys, this is the grand finale of connecting all the things we learned over the course of the last week. We can do further also, just to get you comfortable with how to apply. We can do a formula book. We can create a formula book which we can use. Do you want to do that with me now? Yeah. So let's do that. Let's do that. So if I create a formula book, okay. So what is step one? Step one is jurisdictional one, right? So what is the first thing that I will do? First, I have to find the globe income. That is my starting point, correct? Now this is the starting point, globe income. And then what I would do, I would find what is my cover taxes. I'll do better. I'll do better. Okay. I will calculate cover taxes. You know what is cover taxes, right? Now what is going to I will get jurisdictional. I'll get jurisdictional ETR. Now you have to understand this globe income is total of all CEs in that jurisdiction. Total of all CEs in that jurisdiction. Okay. Then we get the cover taxes. Then we find the jurisdictional ETR. How do I find the jurisdictional ETR? It is nothing but A divided by B. Correct? Now, after I find the jurisdictional ETR, then what I will do, I will calculate the top up, jurisdictional top up tax. How do I do that? It is nothing but 15% minus C. Yes or no? Fantastic. Once I get the jurisdictional top-up tax, then what I do? I will find the excess profits. How do I get excess profits? Or like, before that, what I will do is I would calculate the substance-based income exclusions. I will take the, employee payroll cost and tangible asset net book value, and I will multiply it with the percentages given in law, right? So I would get what? Substance based income exclusions. Yes or no? So this I will paste here so that let the formulas be all clear. Right? Now once I get the substance based income exclusion, what do I do? I will reduce my globe income with substance based income exclusion, and I'll get what? Excess profits, right? It is nothing but A minus E. Yes? Yes or no? I'll get excess profits. And on at excess profits, what I would do, I will add, prior year adjustments. Okay. And I will kind of reduce QDMTT. So what I will get? So what I will get? I will get, if I do all this, I will get the value of jurisdictional top-up. This is nothing but, uh, yeah. So F into D plus G minus H. Any doubts in the formula, guys? Yes, I will get the jurisdictional top-up tax. Now, once I get the jurisdictional top-up tax, then I will divide it in the ratio of the jurisdictions. Right? What all jurisdictions are there? Now, step two is entity classification. Now, for that, what do I do? I will take jurisdictional top-up tax, which is nothing but step one, right? And I will calculate what? Total globe income of all positives, right? And then I will take the globe income of each entity, each positive entity. Yes. And then I will distribute. Distribution. So entity 1, entity 2, etc. will get distributed in the ratio of entity 1 will be in the ratio of what? A into C by B. Correct? Yes. So I will do the division for this also. Yes. Yes or no? Yeah, this is step 2. Now what is step 3? Step 3 is the parent level. So for that, you have to calculate what we call as inclusion ratio of Pope. No, let's assume that there is a Pope. Inclusion ratio of Pope we have to calculate. How do I calculate inclusion ratio of Pope? Globe income attributable to Pope divided by total globe income. Yes or no? How do I get global income attributable to total minus what is attributable to external people? So we'll find the inclusion ratio, and based on the inclusion ratio, I will jurisdictional top up tax is step 1. I will multiply A and B and I will get what? IAR 4. Correct? Yes or no? Yes. We discussed all this over the course of the last week, so you should get this, like, inclusion ratio, and I will find IAR for 4. Then you have to find the IAR for UPE also, right? How would I find IAR for UPE? You have to do the same thing, A into B of the UPE minus C, which is the IAR which is paid by Pope, into inclusion ratio of UPE in Pope. Then you will find what the IAR for UP. And what we did here is what we call as offset. Yes. Okay. Now let's go. What then? If there is even then there is like there is a difference. Then what is step 4? Step 4 we will go to UTPR, and in UTPR what we do? We will find the UTPR percentage of each CE which has a qualified UTPR percentage. And then what we do, excess or residual profit, we will multiply with UTPR percentages. So we will know which entity pays how much. Is this formula book clear? This is the formula book that you will use. Can you give me a yeah? Is this formula book clear? Yes or no? How each level we would be calculating this? Perfect. Fantastic. Oh, there was a doubt. For parent level calculation, won't we be using the entity level amounts? Yes, absolutely. So that's what I'm saying. Once you find the entity level amounts, okay, you take it to the parent level. So parents inclusion ratio and jurisdictional top up tax I've mentioned you. Or I can change the word. This is entity each entities. Okay. Then we will kind of find that. So this is how the whole formula book will look like. It's okay. You can keep on listening. It's fine. Okay. You can keep on listening. So this is how the entire workbook template will look like. Okay. Now we will quickly go into common pitfalls. Okay. What are the pitfalls that we do while doing this? We forget loss making entities in entity allocation, right? You should only take positive ones. Please don't include loss making entities in entity allocation. Then don't use the ownership percentage as inclusion ratio. As I told you, how much is the globe income allocated to each? That's what's to be used for inclusion ratio. Don't double count poke charges. You have to give an IAR offset at the level of UPE for what is the taxes paid at the poke level. Don't include non-UTPR jurisdictions while calculating the employee factor and UTPR percentages. And don't mix allocation formulas. First jurisdiction, then entity, then parent, then UTPR. Okay, never kind of do anything before. And yeah, don't forget the QDMT priority. You should always deduct QDMTT from the jurisdictional basis to find the top up tax allocated to each entity. Is this clear? This is the complete charging provisions which is summarized today. Yes or no? Yes. Okay, then then we can. Okay, so QDMTT is always on an entity. Yes, QDMTT is. Oh no, no, QDMTT is on a jurisdictional, not on an entity. Okay, whatever is remaining after QDTMTT is deducted from the jurisdictional level is what is shared between the entities. Oh, now, documentation requirements, of course, you have to maintain work papers for each level of allocation. I think you already could understand what are the work papers which is required because we went through the formula book line by line. So, uh, globe income calculation, we would need all these documentation for for first thing is definitely globe income because since this is the first line item which we use for jurisdictional calculations, we have to first find the globe income. What is the working papers for globe income? Then ETR, then top up tax percentage, SBIE workings, positive income total, allocation. For UP ownership chains, you have to understand to find the inclusion ratio, allocable shares, IAR offset, if Pope has paid. Then UTPR, you have to find the residual top up tax after IAR. Then employee and tangible asset factor for each constituent entity to find the UTPR percentages, UTPR carve outs in case if they are not in zeros, and the allocated amounts. These are the documentation requirements that is needed, and what returns you would be filing or what documents you would be filing to the tax authorities. You have to, the first thing is uh, let's go by hierarchy. This is not a hierarchy. Okay, so first you will do the QDMTT local returns. You have to calculate QDMTT, and that would be filed in each jurisdiction. That is point number. What is the first thing that we do? Then the UPE will file in their authority something called Globe Information Return. So all levels, how many LTCEs are there after jurisdiction and entity level calculations. That's what is included in Globe Information Return. This the UPE will file. Then after this is filed, we have to file the IAR return. And after IAR return is when UTPR local returns by constituent entities to each user. So this is how the filings will go. First QDMTT, then GIR. GIR would have the jurisdictional and entity level classifications, IAR return and UTPR. Is this clear? So there are a lot of problems like, you can have timing mismatches. Yes, this is how the entire charging, yeah, this is how the entire charging provisions would come now. And I hope it is clear. And if not, we can take offline and address your queries. But I feel over the course of 1 week, we have covered enough content and material to understand how charging mechanisms work. Okay. So if that is very clear to you, then we can, stop for the day. And if there are any questions or like, anything you want to discuss, you can let me know. And I will also be sharing the assignments for charging provision. So you would be doing all this independently. We will do that, and then from the next week we will start um, how to calculate globe income. So this was always a line item in charging provision. How do we calculate that is what's going to be discussed in detail next. And the subsequent class would be how to calculate covered taxes or adjusted covered taxes. What does it mean? So we are now taking care of the base. Now we are slowly moving up. So it's a bottom up approach. But I hope this is clear to you. We can't go to globe income without understanding why it is calculated. So that's the whole approach here. So we will meet next week. Okay. Thank you.